How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 33 to the Asian Session Library. Last night, Thursday, the 1st, February 2024, we can see we had a successful Asian Session model with the pair US dollar versus Japanese yen. Going into Friday, NFP today, it just kept flying. So let's walk through it together. So we're going to go back just before 8 p.m. and we're going to break it down on the 15-minute time frame, and then we'll get down to the entry. So we're taking 12 p.m. to 8 p.m. That's going to be our New York lunch session. We don't want to trade here. We're trying to avoid trading here at all costs. We don't want to trade here because most likely the market is going to go into a phase of consolidation and accumulating orders. In this time period, certain entities are not in the marketplace trading. The algorithm is not geared to gyrate higher or lower during this time period often. More times than not, it's going to be a phase of consolidation. So I'm going to avoid it. But because all markets start in consolidation, that's what we want. We want to see the market consolidate, get tight, so that it can have excitement come into the marketplace. We're looking to trade Asian session, hence it's called the Asian session model. We're looking for the buy side and sell side liquidity pools. So this would be sell side, the lowest low at 12 p.m. right there. We would take that. We would take this swing low because it's unbroken. We would take this swing low here just before 8 p.m. You can see it does break it there. We would take this swing high that forms before 8 p.m. This one as well. And that's what we have. So we have our buy side and we have our sell side liquidity. Going into Asian session, we can see it sweeps or purges sell side liquidity. And while doing it, it moves below 8 p.m.'s opening price. So that's the open here. That's Asian open, 8 p.m., New York Eastern Standard Time. Price comes down quickly. And at this point, what do I speculate? I'm speculating that scenario of a retail trader looking for a break, retest, and then a sell-off. That scenario can unfold, but I'm looking to be counterparty no matter what. Everybody else would chase the price action going lower, while I would look to go long and opposite to them. At this point, breaking that 15-minute swing low, I would stalk on the 1-minute time frame my entry technique. And my entry technique is going to be a fair value gap that runs through a swing high. You can see it right here. Look at that swing high formation with the fair value gap going through it. So you got that fair value gap here with that swing high. So that's where I would be looking to go long. Notice where the fair value gap forms too. It's below, get that correct there for you guys. It's below Asian Open. It's below the opening price. So it's at a discount. It's cheap. It's always ideal to look for a buying condition below the opening price, but with context. Just because price moves below the opening price does not mean you have to buy. There needs to be context. What was the context? Price rated a 15-minute swing low. That was the context there. You can see on the 1 minute with more data, you can see it's clean lows. Very clean. We know the market likes to target clean lows, double bottoms, triple bottoms, etc. There are many relatively equal lows here. Price runs that out. Then after running that out, the algorithm prints this fingerprint for us, this footprint for us, this pattern for us. That's where we're looking to execute. We're looking to go long here, 15 pips minimum, or ideally, minimalistically, I would say 10. You want to get 10 pips, take 10 pips and pay the trader. And we talked about this last night in the channel. If you play it forward, you can see how we got 10, right? We got 10 pips. Let's measure that up. 10 pips was acquired. I would take some off, take partials there. If not, like I said, you can do anything you want. But I personally would take partials at 10 pips. At times, moving the stop loss can cause you to get stopped out because that's the whole point of it. It's a trailing stop. And the market will come back potentially to take out sell side liquidity for those that got in trend with the market. It would knock you out and then continue going higher. So at times, it can be tricky trailing your stop. And if you play it through, play it all the way through, Get there again, right? Price falls back down. So it's just threading the needle. And what I mean by that threading the needle, I'm talking about the Asian Open. Look at how that opening price is very sensitive. They sell above it, they buy below it. They sell above it, they buy below it. They sell above it, they buy below it. Multiple times it does it. Not to say there isn't feasible setups here for the sell opportunities, but just with hindsight and gauging that ideology, you could see multiple times where they're selling. It's not that I'm trying to predict where they're going to sell. I was definitely trying to predict where they were going to buy below the open and then after this fair value gap that broke a swing high for them. And we can see now we get that 15 pip TP a little later in the session. And as price continues going on, go on the 15-minute time frame just for time purposes. You can see going into IPTA True Day, going into Friday, the price action still is looking to go higher. NFP comes around, dollar gets strong, and this trade idea went from a 1-to-1 to way more than that. And you can see when is this setup that occurs, allowing us to have more greater reward? A Thursday. So if you've been watching the series for a while and watching all the episodes, you've noticed I said that Tuesdays and Thursdays in particular, they tend to stand out more in its success rate and its reward. Its reward tends to be a lot greater going into the next day. I can hold that trade going into the next day, looking for more than just 15 pips, 20 pips, 40 pips. And this was over, I think the entry was right around here. Right now, it's currently pushing over 190 pips, 200 pips. So as you can see, it's a very simplistic idea that can also be short term and then also can be used to catch pips into the next day. It's not something that I would say it happens every single day. You're always going to get 200 pips. No, but if you're patient and you're not greedy, these days like this will come. And you may be able to catch it if you have a good trailing stop. Or if you don't even move your stop loss at all at times, you may be able to catch moves like this. But since the data has showed that Tuesdays and Thursdays particularly tend to have these results, not to say Monday and Wednesday does not, because there are days where those results occur as well. They're just unlikely. But because I know the data shows Tuesdays and Thursdays are most likely going to give dynamic setups like this, wouldn't I, as a trader, want to potentially double down and risk more? Yes. So instead of risking 1%, maybe I risk 1.5%. Maybe instead of risking 1.5% or 1%, I risk 2% or maybe even 3%, depending on how I feel. And I stick to that protocol on those days. That's how you know when you should be able to increase risk or lower risk. It's because of the data. You need to extract the data from the market to understand, okay, these are specific time points or specific days or specific months or weeks where I can increase my risk because the odds may be in my favor a lot more. So let's double down. Let's triple down, quadruple down, and etc. Hopefully you found this insightful. Peace.